Hello and welcome back to my channel. This is another video on international taxation, the introduction. And in our fourth chapter, we go on speaking about the basics of international tax planning. So what we have to talk about now is the basic element, how international tax planning can be done probably. That's in most cases contracts with related persons as an instrument. So what do you need to remember? You know that contracts with related persons are respected by tax law, at least when you have to do with a corporation instead of a partnership. Then corporations can always conclude contracts with related persons as long as they are conform with market conditions. So as you can do this, you can now establish a second company and make a contract with that second company, probably in a foreign country, and then you can make agreements that a part of your business activities will in the future be done by that foreign company, and you pay a market conform price for that activities to that foreign company. This way, a bit of the total obtainable profit is then made by that foreign company and not by you yourself anymore. Now that sounds a bit abstract, so let's explain it with an example. You have an inland corporation in a country with 30% tax level, and from selling your products to your customers, you have a revenue of 5 million. Now you set up a foreign corporation in a country with 10% tax level, and now you make a contract about some service or something like that with your own company. For example, imagine the foreign company is the owner of a patent right which you need to use for your production activities. So now you need to ask the foreign company for its permission to use their invention or the invention in which they hold the rights. And so you have now good reason to pay them a license fee. Let's say the adequate license fee is 1 million. So you have now expense of 1 million and they get a revenue of 1 million. So your profit originally was 5 million and the original tax was 30% on 5 million. However, now the situation has changed. Now you have a profit left over in the inlet of 4 million. The tax drops down to 1.2 million. And in the foreign country, the tax base went up to 1 million. And so 10% tax there is 100,000. So if you compare that now and add it together, the total tax is now in the group 1.3 million. If you compare the previous situation with the present situation, then you find out by that restructuring or reorganization of your internal activities within the group, you saved 200,000. Very plain and simple. So the question is, what could you outsource according to the principle? Well, if you are a bit creative, then you can see you can do it with patent rights. You can do it with brand names. You can do it with business ideas. So you can pay for rights. You can also ask the foreign company for money which they have. They give you a credit. You pay interest to them. However, you can even do it with a part of the manufacturing activities which you have to undertake. Let's imagine that again. Inland corporation. Revenue from selling cars to customers shall be 50 million. However, I know 50 million is not much turnover for a car factory, but it's just for illustration. The total costs are 40 million, and now you set up that foreign corporation in another jurisdiction. 10% tax level is there. Foreign corporation produces now the wheels for the cars for 1 million. So you pay for the wheels now 1 million. They have a revenue of 1 million. And naturally, as you no longer produce the wheels, the costs for the wheels are now borne by the foreign corporation. So you have less costs. And now if you compare the situation, originally you had 10 million profit, 50 minus 40, 3 million taxes. Now after the transaction, there is a tax in the foreign country of 10,000, and the tax in your inland drops down to 30% of 9.9 million, so to 297, and overall you save 20,000 euro as taxes. However, we still have one question to solve, because now in this construction the money 100,000, or no, 100,000 profit is now in the hands of the foreign corporation. If we want to bring it back to the inlet corporation, to its parent company, we will have to pay dividends. So in order to check if our tax saving model is really promising, we must also take into consideration what will happen if the parent company later claims the money back from the foreign company in form of a dividend. Then there can be a tax on the dividend in the country where it comes from. So in the country of the foreign subsidiary, that's typically will be a withholding tax, and it could be taxed in the country of the recipient, because cross-border activities can always be taxed in the source country and in the country where the recipient lives, under limited and unlimited tax liability regimes. However, in the country of the parent, usually you have a rule to avoid a so-called economic double taxation, so that corporation tax does not accumulate in the group, so that the total burden of corporation tax is not higher than, let's say, usually one corporation tax. How can that happen, or what will that look in detail? You have the foreign corporation, so if that dividend is paid, you have first a withholding tax, probably in the country of the foreign corporation. You have to check that, how high it is, if there is one, and so, in order to form an opinion if your tax saving idea is really advantageous also in the long run. And you have to find out what happens in the inland when the dividend arrives from the foreign corporation. Usually, if there is any mechanism to avoid an economic double taxation in the group, the parent company will get for the dividend either an exemption. For example, in Germany, that would be the solution. You get an exemption under the German paragraph 8b KSTG, so Corporation Tax Act. Or you would get a so-called indirect tax credit, which limits the total burden to one corporation tax level in total. However, so let's have a look. If we have that indirect tax credit method, then life would be a bit complicated. The dividends would be fully taxed at the level of the parent company. But then, on the other hand, you would be allowed to take the tax which already has been paid by the foreign subsidiary and deduct it from your corporation tax, which is due on the dividend. So in total, you would only pay once the total regular tax burden in the country of the parent. To illustrate this as an example, imagine the profit originally made by the subsidiary is 100,000. The tax paid there is 10,000, so you can pay out a dividend of 90. Then the revenue of the parent company consists of first the dividend which they received in cash, 90,000, plus an additional revenue effect comes from the fact that they can claim a tax credit. And a tax credit is similar to cash, because it lowers your liabilities at the fiscal office, so it is also a revenue. So we see here the total revenue from the dividend payment is 100,000, exactly the same as the original underlying profit of the company. The tax calculated for the parent on that dividend would be 30,000. Now you can credit what has already been paid in the country of the subsidiary, 10,000. So payable by the parent is only the difference, 20. And if you see The tax in the country of the subsidiary 10 plus the additional tax on the parent level, it's 30,000. So when you have that indirect tax credit solution, in the end you end up with the regular 30% tax rate on the level of the parent. That would mean economically the total tax for the profit which you originally made in the subsidiary will later be lifted up to 30%, the same tax rate, tax level, which is customary at the indent. However, for all the time during which no dividends were paid, you have the tax advantage that for all that time, these 20% are not yet payable, so you have a strong liquidity advantage. And by the way, the logical consequence of that delay of the later part of the total tax burden is that the parent company will in practice delay dividends from the subsidiary to the parent as long as possible. For example, if they need cash, they rather ask the subsidiary for a credit and then pay interest for it even. So you can suppose that in these constellations where you have indirect tax credit method, you cannot keep up in theory the lower tax rate level of the subsidiary for eternity. However, in practice, you will try to keep it as long as possible, nearly until eternity, at the level of 10% by avoiding dividend. That makes it understandable why other states say, okay, let's expect that our tax planning departments of major multinational groups are a bit intelligent, so they will probably never pay out these profits of the subsidiaries as dividends as long as they can avoid it. So virtually we never get that money, so we can make life more simple and we could practice the exemption solution for dividends collected by a parent. Then at least the money can freely circulate within the group. In that case, when a dividend is paid, the total tax burden is not increased to the parent company's level. So the tax level at the foreign company stays definitive, even without such tricks than delaying the dividends and so. Under bureaucratic aspects, the exemption solution is far more easy naturally. So one can understand why sometimes countries like this. Now, how will countries choose probably their methods? Countries will probably try to treat the profits from a foreign subsidiary similar to the profits of foreign permanent establishments to guarantee some neutrality. So if a country treats foreign permanent establishments according to the exemption method, it would make sense also to treat dividend as exempt, because then in all two constellations, the lower foreign tax level stays the same. However, if a country prefers to treat foreign profits by the credit method, so to lift up the foreign tax level to their home state level, then it would be plausible and reasonable that they also treat dividends paid out under the indirect tax credit method. So we can sum up: if you let a part of your activities be done by another company of your own group, you can either save taxes for a long time or permanently. And the only condition is that the tax rate for the profits of the foreign company is lower than the rate in your country. So the only thing, what we really need to know is that the tax in the foreign country is lower. Now, what must we check in order to be sure that this is the case? That foreign company can be taxed in its own country of residence, because there will be a worldwide income taxation, so they will also be taxed for everything which they earn in doing business with us in the inland. Plus, there could be a tax in the country where the income comes from. limited tax liability, as Germans would say, or the non-resident taxation rules, like others would call it, or due to the territoriality principle, or however we call it. Let's just sum up. Naturally, that flow of income could be taxed where it comes from and where it goes to. So you have to check that the usage of that foreign company is cheaper by checking the treatment of that company in its state of residence and how the income is taxed under the rules of the state where it comes from. For that, you need to know their national, so their domestic law, and the rules of their double taxation treaties and how they apply them. Relevant rules might be Article 7.1 of the OECD Model Convention, which is very convenient because it says business income can only be taxed in the country of the business owner. So foreign company only needs to pay taxes on business activities in their own country if they do not have set up a permanent establishment in our inland. So that means, for example, manufacturing activities, if we outsource them to the foreign country, they will not be taxed in our country. Very often you have that same principle, the so-called permanent establishment principle, also enshrined already in national law, so that you do not need to take refuge to a double taxation treaty. For example, in German national law, limited tax liability does only cover income from business which comes from an inland permanent establishment, at least in most cases, so that even if the manufacturing activities would be outsourced to a country where we don't have any double taxation treaty with, the business activities would not be taxed in the inland, but only where the company resides. If interest is paid, then Article 11.2 of the OECD Model Convention might be interesting. That says in the source country, interest can only be taxed at a very low limited level. Usually 10% is the OECD's proposal. Many countries even agree on lower upper limits, so that might be 5%, or very often there might be even an upper limit of 0%. 12.1 license fees. There are some old DTTs still running free in the world where a license fee can be taxed in the source country with a withholding tax. However, all the modern versions of double taxation treaties usually stipulate that Article 12.1 says license fees can only be taxed in the country of the recipient. So if we pay for a patent right to that foreign company and we have a double taxation treaty with that foreign company, then this license fee payment can in the end leave our country without any tax in the source country. So creating a transaction by making a payment from a company in the inland to a company of the same group in the foreign country can very often be done on the basis of nearly no or a very low tax in the source country where the money comes from. So the source country, let's say in our case, in my examples, it was always the inland company's country, loses nearly all the taxes and all the tax revenue. So that can be easily done. You have more than 200 states worldwide where you can select from. So you can decide where you set up your company, for which purposes, or if for manufacturing purposes, for patent rights, for business ideas, or for what else. And as you have so many possibilities to choose from, there will always exist a good choice. And a natural and necessary conclusion is, if all that is so easy, then it will be done. And you can prognosticate, the more globalization goes on, the more and more easy will it become to make usage of that possibilities. To set up a foreign company nowadays, that can even be done online in many countries. So you do not even need to be there. You would have then just to take care that you appoint a manager in the local jurisdiction so that the place of management is also there. However, it can easily be done. And if it can so easily be done, it will be done. And if it will be done more and more, then the states where, let's say, traditionally rich enterprises are will come more and more under pressure and lose more and more of the tax revenues. So they will have to find solutions to do something against that if they do not want to lose all their tax revenue. And that, what can be done, is then a question for our next small video. So enough for today. This was a short one rather today, so enjoy that it's over. Recover well until the next time, and don't forget to come back. Recommend if possible the channel to others. You remember our basic rule: if you liked it, recommend the channel to people whom you like. If you didn't like it, recommend the channel to people whom you don't like. And if you got this channel by recommendation, probably for you, now the question is, how can I find out which of the two alternatives applied to my situation? Perhaps you never find out. Okay, so let me stop now, say goodbye, till next time. Okay.